we go back to our mid-year recap in July, we were talking about the divergence between the market cap weighted index versus the equally weighted, driven by the big tech companies, Nvidia, Google, Meta, Apple. We've started to, and at that time we said, hey, there's some opportunity for that gap to start to narrow. And we've seen that so far in Q3, where we've got small cap, mid cap, other sectors that are starting to catch up to those big tech companies.
The thing we need to remember here is the Fed is regulating interest rates because they're trying to regulate inflation while also balancing what is needed for stimulus or cool down in the economy. So think about it like, a seesaw. They have two things they're kind of working on here. And in the 80s, they just had runaway inflation coming out of the 70s, so very high rates, and it took forever for this to kind of come down. I think the Fed has done a pretty good job in this scenario, and we'll get to another slide talking about that, in starting to make those cuts in an appropriate manner. Some may look at this and think, oh gosh, we're contracting. But really, we're not talking about a massive rate of change in manufacturing. We're looking for that soft landing that the Fed has talked about quite a bit. And this looks about as smooth and soft as I think you could hope for on the manufacturing side. Then you look at housing starts, you look at consumer credit, retail sales. This isn't a drastic change of events here. This is about what we would expect from the raising of rates. There is a difference between the market and the economy. And so kind of thinking about the economy being a snapshot of where we are today, what's happening right now in different areas of the economy, from government spending all the way down to the consumer. The market is really forward-looking in terms of what can play out. How are corporate profits going to be? How are they going to be impacted by interest rates? What are the geopolitical risks? There's so many factors that go into a market that drive it.
Who's in office can have a small, factor on a company's profitability, but there's so many other factors such as supply chain, inflation, hiring the best talent, research and development, marketing and branding against your competitors that is driving corporate profits.
And if you think about it from the perspective of a CEO of a publicly traded company, let's say you're running a company over that entire period there, and you're managing the balance sheet, the P&L of a company. Well, you're not going to just hang up business because somebody's in office. You're going to keep finding ways to be competitive, to produce free cash flow, to produce shareholder returns, to produce either a dividend or reinvest your capital. And so you have to think that same way as an investor. Despite your environment, despite the outcome of an election, staying invested is prudent.